In this video, I'm going to show you how you can make an extra £1 million over the next decade without paying a single penny of income tax by buying property in a limited company rather than your personal name. I'm also going to reveal the two major advantages that all the other gurus miss when talking about this subject. Discuss the stealth tax that nobody is talking about right now that's going to destroy your income if you don't do something about it now, and how you can seriously increase your wealth with no extra effort just by ignoring a lot of the mainstream opinion. But before I crunch all these numbers, I want to put out a huge disclaimer that I'm not an accountant, I'm not a tax advisor, and therefore everything I talk about in this video is just my personal opinion. It's also important to state that this discussion is completely contextual, and everybody is going to be in a different set of circumstances, and therefore it's important to understand what's right for you. But why has this debate become such a hot topic in the first place? Well, in George Osborne's 2015 budget, the first shots of the war against landlords were fired.
We will create a more level playing field between those buying a home to let and those who are buying a home to live in. So we will retain mortgage interest relief on residential property, but we will now restrict it to the basic rate of income tax.
And soon after, his autumn offensive started, with buy-to-let now being fully targeted.
Frankly, people buying a home to let should not be squeezing out families who can't afford a home to buy. So I am introducing new rates of stamp duty that will be 3% higher on the purchase of additional properties like buy-to-lets and second homes.
So, what does all of this mean for investors? Well, in the good old days, it used to be easy to work out what tax you're going to pay on your profits. Let's say your rent is £1,000 a month. You've got costs of £200 a month, could be management fee, maintenance, and your mortgage interest is £400 a month. Your profit is £1,000 rent minus the £200 cost, the £400 mortgage interest, which gives you £400 of profit. And if you own this property in your personal name, that profit is going to be taxed based on your income tax rate. So let's say you're in the 20% income tax bracket. You're going to be paying £80 tax on this, because Section 24 has changed everything. Because the government in their wisdom have said that £400 of interest costs that you've used can no longer be used to offset against your tax calculation. And they've somehow rewritten the laws of maths and accountancy to say your profit is no longer £400 a month. It's now £800 a month, which is your rent minus your maintenance costs. So if your monthly taxable income is now £800 a month, you'd be taxed 20% on this, which is £160. However, because they're such a nice bunch of blokes over at the government, they will give you a 20% tax relief on the interest element. So in this example, on our £400 of interest, we get to claim 20% tax relief, which is £80 tax credit. Take that away from the £160 tax we're being charged, and it leaves us with a net tax to pay of £80, which is exactly the same as the original calculation. Unnecessarily confusing so far? So what's the point of all of this? Well, the changes really start to take effect when we get into the higher tax rate brackets. And of course, as our taxable income includes the interest element, we're going to get there much more quickly. So let's assume this is the same property, but we're now a higher rate taxpayer at 40%. Before Section 24, our £400 profit would be taxed at 40%, giving us £160 tax. With Section 24, our tax is now going to be 800 times 40%, which is 320. But don't forget, we still have our tax credit of £80. And so our net tax will be £240, which is 50% higher than before. Now, we'll look at a tax if we own this property in a limited company in a minute, but I guarantee what we look at is going to shock you, as I'm going to demonstrate how you can make over £1 million extra over the next 10 years by just making a small tweak to how you structure your property portfolio. And if you're looking to grow your wealth and your property business the right way, do yourself a favor, find and hit that like button and subscribe to the channel right now to make sure you don't miss on more of these videos going forward. Now, getting to that figure from property income alone might seem like a long way away for many, but there's two things that we need to understand that are going to seriously affect this decision for us. Firstly, with the continued ramp up of interest rates right now, this interest rate element is going to get larger and larger. And this creates a double whammy effect for investors, because not only are you now making less cash flow from your property portfolio, incredibly, we can't actually reduce the amount of tax we're paying. So let's just break this down using the same example. Assume that our interest element has gone up from £400 to £600 a month. And this is not an unrepresentative rise for a lot of investors right now. So our income has dropped from £400 to £200 a month. Now, under the old regime, our tax would have also reduced. As a 40% taxpayer, we'd be paying £80 a month on tax, which leaves us £120 a month in the bank. But under Section 24, we still can't offset any of that interest. So our main rate of tax is £320. Then we're getting our 20% tax credit, which is £120, meaning we have a net tax to pay of £200 on our £200 profit. We are no longer making any money. Now, the second thing to consider is the huge stealth tax that was introduced in the last budget that nobody's talking about, and that is the income tax bracket freeze in a high inflationary environment. Because with high inflation, it follows that rents are going to have to follow up as well, which means that you're going to be pushed into that higher rate tax bracket much more quickly. And this makes Section 24 much more relevant for all of us. And finally, with the increase in interest rates, investors are looking for much higher yielding properties. I've been teaching for some time that buy-to-let version 2 is all about high cash flowing and higher density property investments. And when you're investing in properties like this, just one of them may put you into that higher rate tax bracket. Now, investing in a limited company is much more simple, as we can still offset the costs of mortgage interest, as well as various other costs like paying yourself a salary. Your profits then taxed at the corporation tax rate, which right now is 19% for the first £50,000 worth of profit, and then sliding up to 25% when you hit £250,000 worth of profit. Now, when we zoom out and look at this, I'd like to think it's obvious that being taxed in your personal name at 40% without being able to offset your interest is going to be more expensive than being taxed at 19 to 25% with being able to offset your mortgage interest. But of course, it's never as simple as that, and there's an issue that needs to be discussed, which is how do you then actually take that money out of the limited company after you've made it? Because when you're buying properties in a limited company, you're not actually buying them in your own name at all. The limited company is buying them and you own the company. So the limited company has its own tax rates which are more favourable. But if you want to get your hands on that money, then you're going to have to extract it via dividends or salary, and that's then going to be taxed again. But all the other analysis I've seen on this makes a direct comparison of earning the money in your own name versus taking out the same amount from your limited company. But my challenge to this is, why would you take it all out of the limited company when you can leave it in a more tax advantageous wrapper and reinvest it? So my question to you is, why are you actually doing this? Why are you in property, and what do you need to actually live off every year? Personally, I lead a pretty frugal life, and I only take out of my companies what I need to live, and all the rest gets reinvested to compound growing wealth and legacy. So what I want to do is compare the two scenarios using a deal that I'm buying right now, which is a mixed-use building with a restaurant and 4 flats. I'm buying it for $350,000 and estimate the refurb, stamp and legals to be about $105,000, meaning a total investment of £454,500. Now, we're actually going to be operating these flats as serviced accommodation, but to give it a fair comparison, I'm going to use the 1-bed flat rate in Chester, which is £700 a month, and the restaurant is going to rent out at £2,000 a month. So the total rent roll is £57,600 a year. You can see straight away that we're already going to be going into the higher rate tax bracket if we buy this in our personal name. I'm also assuming a revaluation using a 10% yield, which gives us post-works value of $576,000. Now, assuming a 70% loan to value mortgage, we'll be pulling out just over £400,000. And with a 5% interest rate, that equates to 20 grand a year or £1,680 of interest a month. Now, I also want to assume that we can reinvest these funds after we pull them out and end up buying 4 of these over the next few years. So let's start by looking at the model if we bought it in our personal name. The annual tax on the first one isn't too bad at just under £6,500, but properties 2, 3 and 4 ramp up due to being in the higher and additional rate categories. So you can see property 4 is returning us just over 15.5 grand from a 57,600 gross income. In total, our annual post-tax income is just over £81,000. But what happens if we do the same in a limited company? Well, as we don't have different income tax rates, I'm just going to calculate all 4 of these at once, but also assuming that I'm paying myself £12,500 a year in salary, which is our personal allowance and so tax-free. So you can see our pre-tax profit is just over £137,000, and with the sliding scale of corporation tax is giving us a post-tax profit of £104,585. But we've extracted that £12,500 worth of pay already, so to give an accurate picture we need to add that back, which gives us a post-tax figure of £117,000. Now when we compare these, that's a difference of just over £36,000 a year from just these 4 properties. Now that difference is sitting in our limited company, so we can't just take it out and spend it without having tax on it again. But what we can do is reinvest it and compound that in our limited company. I do also understand that we need to live, and I get that we're not going to have much of a quality of life on just our £12,000 a year personal allowance. So how can we extract out more of our cash? Well, we do have a very small dividend allowance, which means we can take £1,000 a year dividends tax-free. It's another thing that the government have trashed, but it does mean we can now take out £13,500 a year tax-free to start with. Now, let's say we need 50 grand a year to live a comfortable life. we'll need to pay ourselves another $36,500 out of the limited company to hit this. Well, let's loop back to the very start where we put just over 450 grand of investment funds into our limited company to start with. Now look, I'm not claiming that everybody's going to have hundreds of thousands of pounds to seed their limited company in their property portfolios, but I want to highlight the concept here. Because if you're buying a limited company, you're going to be putting that money in as a director's loan, which means you can then extract that, again, tax-free. So if we've put in 450 grand to start with and we need another 36 grand a year out of the company to live on, that means we can pay back that director's loan over the next 12 and a half years totally tax-free. And in the same period, if you take that difference in income in our limited company and put it into a mechanism that gives us 12% a year compound interest, which by the way is very simple to do if we use momentum investing, then you can see that the limited company will be over £1 million better off and you haven't paid a penny of income tax for the whole time. And that, my friends, is how you build significant generational wealth with as simple a mechanism as you can. So whilst the gurus are there splashing images of supercars and lavish lifestyles, there is a secret community of underground millionaires who are quietly building significant wealth which can then be handed down to the next generation in a tax-efficient structure. And if you want to learn the building blocks of how to do this, I've got a totally free training course called the Property Cashflow Kickstarter, which you can access now totally for free, and I'll put the link in a pinned comment under this video. And if you want to see a case study of how you can retire from just one deal, then check out this video right here.